Now we get to Rephael. He had some sound issues earlier. I apologize I couldn't get to those questions earlier, Rephael. Not a strategy I do, but we'll try to address it as best as possible. Rephael says, this is my question. I've been selling straddles 30 to 45 days out in time with about a 0.5 or delta neutral. I'm thinking of doing the same thing, but with 75 to 100 days to expiration, simply because the premium is higher. Any obvious advantages or disadvantages this longer approach? Thanks in advance. Okay, I forgot to usually add, this is important, that I close the positions when I reach a 40 to 50% maximum profit. Okay, so what are we talking about here? Short straddle is not a position I trade. You're essentially selling a call and selling a put at the same strike price for the same expiration date. Naked call combined with a naked put position, essentially. Broker has a subtly different margin requirement for straddles and strangles instead of charging the full margin requirement for both naked positions. Now, it's a very steep profit and loss chart. What is the advantage of this short straddle, the reverse tent, profit and loss chart, versus a short strangle, where I'd sell an out of the money call and an out of the money put? And so, because as Rephael mentions, and he's looking to improve on now, the return here with the at the money, because you're getting the most time value for both options because you're at the peak of the at the money bell curve. You're right at the money. So you're getting the most time premium at the time for both the call and the put on that expiration cycle, which gives you a wide upper to lower break even in most cases, but an extreme amount of risk in one direction or the other based on sudden shifts in the market conditions. Going out of the money with the strangle, you've got a better probability between the upper and lower break even. We have a wider upper and lower break even, but you're taking a much lower return because you're further away on the at the money bell curve. The question, of course, in this situation is, do you think it's better to go 75 to 100 days out in time rather than the 30 to 45 I've been doing to get the higher credit? And the simplest answer, well, I'm not going to do the calculation for you. We're going to look at some examples, don't you worry. But the simple answer is, what is the rate of change you've seen in the last 275 to 100 day cycles versus your increase in premium on the straddles you're looking at? What do I mean by that? 30 to 45 days out on SPY. This is a 3-month chart. So 30 to 45 days out, let me scroll down a little bit more. Okay, so we're talking about from, right about here to current. Now, I know this does not the market make. It's one isolated fringe, but this is pretty tame. It's 410 to 425. He probably would have been, Rephael probably would have been selling 420 strikes at this price and, on this position, maybe getting $8, $9 a premium. Fluctuates up and down. At one point here, he might have been able to close for 40 to 50% at the 420, maybe even here as he's getting closer to his 30 to 40 day out expiration. Now, if you went back to, let's say, 3 months ago, we go back into April, and you did a 30 to 45 day out strangle. That looks pretty good. Hopefully you missed this mark, but as it starts to climb, you might manage. Then you do another 30 to 40 day. This slope would have been tough to get through, I understand. But now here you're looking pretty good. But you can kind of see where I'm going with this. If I went to April and I sold here, and we sold the 390, sorry about that. We sold the 395 straddle in April, the at the money straddle in April for 75 to 90 to 100 days out to where we are today. Well, would we have gotten $30? To where we're losing money right now in the position? Maybe you would have, maybe here you might have gotten that 40 to 50% profit you were looking for. You probably would have, I would assume. But that's what I'm talking about. What is your increase in return you're seeing in your comparisons, Rephael, to looking back over, say, a chart of SPY or the underlying you're using right now, based on what has been the fluctuation of percentage movement in that security over 75 to 100-day cycles versus increase in premium compared to the 30 to 35 days and the lower premium. This wasn't exactly April 1st, but I think it's pretty close. It's it's much further back. They were looking in March here, maybe looking at March 1st or March 10th, obviously, wouldn't it? That'd make perfect sense, Mike. 3-month chart, we're looking at March 10th. Let's go back to power options. Let's clear up these drawings. Let us go to short straddle, back test. We're just going to do, this is going to take a while because we're loading the back ones in the background, okay? All right, so I want SPY. I'm going to keep it less results. All right, I'm going to pause the screen real quick. I'm sorry. It's quite all right, folks. What I'm going to do is, this is our webinar account, of course. It doesn't have full access to all the tools because we just use a standard trial account. And Raj, I'm going to answer your question when we go back to that trial account as well. Yes, I know you're not seeing what I'm seeing. I've paused the screen. I'm adding short straddle to the full account here, going right back to where we were. Sorry about that. All right. Now we're going to go to search by symbol again. We're going to go to SPY. We're going to keep it at less results. We're going to go back to March now. And we're going to go to the 10th. And I'm going to go to June expiration. I hope June series was available in March. It should have been, right? Close to where we thought. We said 390. On the 10th of March, SPY closed at 389.58. June 18th is 100 days out in time. 1631 for the call bid, 1658 for the put bid. And it's total net credit of 32.98. Now let's look at how these two perform. Or this one particular, we're staying with the 389. I'm sorry, I should have made that clear. I'm staying with the 389 in this case for the slightly higher net credit, only 20 cents higher than the 390, but we're sticking with 389. So now that I do this, I'm going to look at analyze position. This is going to give me a breakdown of every day. I know we're going to try to adjust this a little bit here. We're going to use the scrubber to sort of give us a clearing. What we're looking at here is the red line on this graph is our return. And this actually isn't too bad right now. With 8 days to go to expiration, we've taken in the cost basis, remember, of 32.98. If we close the position now, our put's essentially worthless. The call is up at 35. So we're losing about 247 or 0.7% on the position right now. So we're losing about 247 total on this position right now. And at expiration, it'd be about the same, right? Because we're at 421. I'm sorry, I forgot to look at the price today. In any case, I'm sorry. Yeah, no, it's much higher, 425. So, okay, where do I want to go this? Right now, you're looking at a loss of about 0.7% today in the next 7 days or so. It never got to your 40% return. And that's not too bad. You just see where it's going here. Return day by day. That 0.28 is a 0.28%. That's back then. That was at the beginning of the trade. We go here. Yeah, still at 0.3%. It never really got much range there in those cases. And down here, what you can see, it's a little easier, more what you're looking for. The stock price is this brown line versus the short put bid dropping and the increase in the short call. This was on 5.7. Was that the lowest? Yep, 1.2% loss on 5.7 for the position. Okay, let me go back. So on March 10th, you would have taken in 32.98 credit for the 100-day out short straddle. And you've essentially just been break even the entire time. In that case, okay, you'd never hit your 40% target win on this. I know 3 months does not a market make, Raj. I'm just trying to give you some examples. Let's keep a short straddle for March 10th. Go to April expiration. April 16th. We're going to stay with the 389s. That's only a fair comparison. You would have gotten 1792. Okay, so we would have gotten 32.98. And here we're getting 1792, a little bit more than half, which is what we expect. As we talked about a little bit earlier, if you sell 3 months out, you're not getting 3 times the premium. You get a lower cost per day by buying the further out options, even though the price is higher. That also means a lower annualized return by selling further out. You typically get a higher annualized return selling month by month or week by week, as you know. Okay. All right, Rephael. So what happened to this position? The 389 straddle on March 10th for April 16th expiration. Okay, so that's the old one. All right, here we go. Oof. On expiration, we lost 991. Okay, so our put expired worthless at 888 and 1879 loss on the short call. Excuse me, we had went up to 2783 because of the increase. The most profit it ever had was 1.6%. All right, so this was a loss of 991 or 2.7%. The 991 is the most important, Rephael, of course. Go back. Change the date to April 19th. So after this spread was closed for maximum loss, assuming we held it all the way to expiration, Rephael, we go to May. So our 419 to 519, or is it 520? We'll find out in a second here. There we go. It's at 415.21. We'll stick with the 415s, little higher net credit. So this would have been the 415s for 21st of May. 21st of May. And I'm sorry, 415 strike, and we would have gotten 1401. And how did we do to May expiration? I'm not going to calculate the group results because we're just really focusing on this one position as well. All right, just one more of these, then we have our comparison done. Okay, so we gained 13.99. Fantastic. So we did the 415 call and the 415 put. And at the very end there, the stock price, let's go down here to see where we were. 414.94. Couldn't have planned that any better, could we have, in that case. So we got a 3.4% profit, 13.99 here. Pretty much the full profit. Why is this only 3.4% and not 90%? It's based on the margin requirement, not the premium we took in. Okay, we took in 1401. It only cost us 2 cents, 4 cents to buy back the 415 put because it was 14.98 or so. So we've got profit of 13.99. So that's plus 13.99. But the percentage is based on that large margin requirement. Yes, I almost slipped and said large margin there, but the large margin requirement in that case. So that's why you're seeing 3.4 instead of 100% return. All right, last one. And I'm sorry, we changed our date to the May expiration going into June. We don't know. This would be May 18th. No, I'm sorry, 24th. I'm sorry, the 24th. So we saw where we were on the other position. We're essentially at break even. You know, it was a loss, I believe, of 247 total. If we had opened an SPY spread at the money spread at March 10th for June 18th expiration. And right now, if we opened on, May 24th, following May expiration, 419.17, we're going to stick with the 419, a 1244 net credit taken in. And right now, and we're going to compare it to right now because we looked at the 247 loss, we're at 538 gain on the May to June series. Again, does not necessarily the market make. I understand that. But just looking at a quick comparison of how the market has changed, you saw that if you had done the 100-day out straddle opened on March 10th at the money, you would have stayed at the money, I'm sure. 395 strike, that's the definition of a straddle, of course. 398, we used the 389, excuse me. So it wasn't quite 395. You had a loss right now of $2.47 on this position, and the highest it ever got was a return of about 1.8%. So maybe 246, 247. Now, that's the tricky part, Rephael, because you'd have to look at the math again. And I see when you meant 40 or 50%, you meant 40 or 50% of that total $32.98 that you would have taken in for the 100-day SPY straddle on March 10th. Now, doing the 30-day out straddles, we lost $9.91, which was a fair percentage amount of what we had taken in, but then you gained $13.99 in the next cycle, which was near 100% gain if you're basing it off the $14 credit. And then right now, if we liquidate it, as you liquidate here, you've got a loss of $247 from the 100-day trades at the 389 strikes. I'm sorry, right there, 389 strikes in that case. You're at plus 538. So let's call it plus 14, plus 1937, minus 991. So you're just under, you're about $9.87 profit by doing one every 30 days versus a loss of $247 doing the 100 days, even though you took in the higher net credit. This is not every stock. This is not every situation. But you can see based on what movements you're expecting, does the higher net credit that you received here for a 100-day trade negate the volatile, not saying this is volatile, but negate the movements that you see where you had a big loss here, but then you had two big gains, including almost 100% gain on the straddle, if that's how you're calculating it, in that second month, which it's night and day if you look at the profits between the two. Again, going back to what we talked about before, you're always going to see a higher annualized return selling week by week or month by month by month. The shorter term also gives you a little bit better ability to manage the positions if you need to roll them out further out in time. Going 3 times the amount of time out in time does not give you 3 times the cost. It was a little bit more than double, right? So this 30-day one here, and we took in $14, that's just a little bit more than double what you took in for doing the 100-day trade, which is 3 times the length. If everything worked out on these, we would have made $8 or $9 there, the 14 we made here, and then another 12 here, and that would have been higher than the 32, right? We would have 26 plus another 10, it'd be about $36. So you'd have a slightly higher return going month by month. So those are usually dilemmas when you're comparing farther term and nearer term ones. When you're selling, you usually want to be selling nearer term. It does help with the management. Getting the higher net credit looks great, of course, in those cases, Rephael, but you're getting a lower annualized return. And if you get caught in a position where you've hit your trigger to roll it, if that 100-day straddle you opened on March 10th to June 18th, if somewhere in the middle there you would hit in a 40 or 50% loss, or double what the net credit was, and you wanted to roll it out further, you're already out in June. Let's say that happened in April. If August wasn't available, you had to roll out to September or October. If my April one got in trouble, I could roll out to the May or to the June. That's the easier management when you're keeping it shorter term in those cases than going further out when selling the premium. Just my opinion. Everyone has their own different management techniques that work better for them one way or the other.